Welcome. We'd like to continue with our DataBreak series. And today we're going to talk about inflation and real estate. Inflation, of course, is a headline topic. Inflation is the gradual loss of purchasing power reflected in a broad rise in prices for goods and services. And really what it does is it erodes purchasing power for consumers and businesses. In a healthy economy, annual inflation is typically in the range of 2%. But the bottom line is inflation creates an environment where a dollar today can buy more goods and services than that same dollar will be able to buy tomorrow. It can be positive when it's within a reasonable range. That's the 2% target. It stimulates spending and spurs demand and productivity. But when inflation surpasses wage growth, it's the sign of a struggling economy. And of course, that's where we are today. To define what inflation is, let's take a moment and go to the Bureau of Labor Statistics. They have a great website on this. Let's look at the Consumer Price Index, and it explains inflation and says it's the measure of the average change over a time in the prices paid by the urban consumers for a market basket of consumer goods and services. Indexes are available for the U.S. in various geographic areas, and it breaks it down into utility, automotive fuel, food items, and so forth. So we can see from the release that at the moment, inflation seasonally adjusted is 8.3% over the last 12 months. The news release actually gives us a little more detail, and it's very interesting because it disaggregates all the items that are involved. So if you follow along on the table, it shows what the total is, that 8.3% we were talking about, and then you can see changes in various sectors. It's interesting to see that over the last couple of months, there's been a dramatic decrease in the price change, and of course we're all enjoying this fuel, gasoline, and so forth. So that's held inflation down a little bit from where it was. As we continue, how does inflation work? There's an excellent graphic from Investopedia that shows it is demand pull. That's when demand for goods and services exceeds the production capacity, so the price goes up. And then there's cost push. That's when production costs increase prices. It just costs more to make it. And then there's kind of a built-in layer. That's less important, but that's wages rising, prices rising in order to maintain living costs. There's an interesting economic rule called the Taylor Rule from the Federal Reserve Bank of Atlanta. And let's take a moment and go to that website. The Atlanta Fed gives some real interesting details about this. The page we're looking at actually is a few years ago with the explanation, but it does a great job of graphing and showing what's happening. The Taylor Rule really looks to maintain inflation at a 2% number, and it shows how the Fed funds rate can have an impact on inflation, making it go up or down. And that's what we're dealing with today. That's why the Fed is raising the Fed funds rate. They're trying to implement the Taylor Rule utility to bring down inflation. One of the big differences, though, and this is the St. Louis Fed website. I'm a big fan of the St. Louis Federal Reserve Bank. They're called Fred. But it shows in this graphic U.S. public debt. And you know, we're now north of $30 trillion. Well, look at the change that we've had in the last couple of years. This is a major factor in driving inflation, bringing more capital to bear without increasing production creates an interesting problem of this demand-supply imbalance. So when we think about inflation, where we are today, and maybe where it's going to go, let's take a moment and look at real quickly what inflation is going to be in the future. The best definition for that is TIPS. Treasury inflation-protected securities. And the difference between U.S. Treasury bonds and TIPS of the same duration is typically a measure of the market's expectation of future consumer price index increase or inflation. So let's look for a moment at the best chart for that, which is FRB H15. This, of course, gives us the Fed funds rates for Treasury securities and inflation indexed. It's what they publish. FRB H15, good thing to track. So if we look at the moment, the 5-year is 390, and the 10-year is 367. So the math on this is we take 390 and we subtract the 5-year TIPS, which is 164. That gives us 226. If we do it on the 10-year, that's 367 minus 143, which is 224. So the market is telling us that inflation is coming down, that over the next 5 years, it's going to be about 226. The next 10 years, the market is saying it's 224. This is very positive as an outlook and very good for fixed assets. So just something to keep in mind, monitor and check. How long it's going to take for this adjustment, we don't know exactly, but we can appreciate that things are not going to be as bad as some are forecasting. Future inflation is really going to come down. Let's also think about how real estate is impacted by inflation. When we think of the Appraisal Institute, which is the basic metric for valuing property, they use 3 approaches to value: the direct sales, comparable sales in the market. They use the income approach, which is capitalizing the rents. And then the third is the cost approach. That's a set of procedures through which the value indication is derived based on estimating the current cost to construct a reproduction or replacement for the existing structure. So think about how that would apply in an inflationary environment. As prices go up, the cost to replicate the existing structure goes up. And so, as the Appraisal Institute model shows, the value of real estate would go up. This is a positive. It means that real estate keeps step with inflation. The other issue is increased rents. And it's interesting, there is a BLS website that actually talks about that. It talks about how to use the consumer price index for escalation. And the market looks at raising things such as rents based on CPI or inflation. So it's kind of built in. This is a very strong positive, again, for real estate, that the income stream, which is the way we would come up with derived market value, goes up over time as inflation goes up. And frankly, it tends to kind of keep step. The final part of it looks at demand. And demand for real estate is all about population. One of the best tools for tracking population in the United States is Census Quick Facts. I really love this website. Many of my compatriots use it as well. It's simple, easy, free, good access. And so what we're displaying here is kind of a benchmark demographics format, which looks at the counties that we're active in, Lake County, Osceola County, Polk County, Orange County, and then indexes those against Florida and the United States. So if we look at this for a moment and we see the population change that's taken place over the last, it's actually 456 days if you want to be very specific, so it's about a year and a half, we can see that the United States grew by 0.1%. Florida grew 10 times as fast. And then you've got Lake County, Osceola County, and Polk County that grew 30 to almost 40 times as fast as the country. It's interesting that Orange County's population has actually slightly declined over the last year or so. And many people say, well, what's going on there? Polk County and Osceola and Lake are the beneficiaries of that because real estate prices are lower for residential homes, And so many people who work in Orange County have found a way to move and live in places like Polk County. We do have a graphic chart that we've done by extracting this information, putting it in Excel, and giving you some interesting, just data points that are good cocktail conversation, like growth per day. Polk County is growing at 62 people a day. Florida was growing by about 750 people a day for the last 10 years, and it's slowed down a little bit to only a little more than 500, but we see that accelerating in the future. This corridor of Central Florida is going to benefit from increased growth and in-migration for the next 10 years. So it's a good place to be. And that really is the final comment on why real estate is an excellent hedge against inflation. Replacement cost goes up, where you're able to raise the rents. And then, of course, it's even better when you're in a geography that's growing. More people is more demand for space or real estate. So thank you for being with us today. Hopefully you appreciated the insights on inflation. Remember to use FRB H15 to estimate where it's going to be in the future. That keeps you from feeling a little too depressed. And then appreciate that real estate is the right asset to keep pace with inflation. And in situations where population growth is exceeding the national average, real estate will actually outperform inflation in a meaningful way. Thank you for being with us. Let us know if you have any questions about commercial or land real estate in Florida. We're honored to be of service.